Hi there, welcome to Lesson 9. In this lesson, we finally introduce one of the main risks that we encounter in quantitative risk management, that is to say, market risk. We will start by giving a definition of market risk, and then we will see what are the main approaches that we can use in order to play with market risk in the so-called Basel framework. The Basel framework is a set of international regulations for the banking sector, but they are so important that actually they have consequences on the financial world in general. So we will see something about the computation of the loss distribution. We will see that in order to have this loss distribution, we can have different approaches, and together we will discuss the two main approaches, the historical simulation and the model building. For what concerns the historical simulation, as the name suggests, we will use historical data in order to simulate a possible future loss distribution on the basis of which we compute the valid risk, the expected shortfall, and other quantities we might be interested in. In the model building approach, that will be the topic of lesson 10, we will use some theoretical models in order to model the dependence among the different market variables that are of relevance in the market risk framework. But let's start with our class. Using the definition of the Basel Committee on Banking Supervision, we have that market risk in the Basel framework is defined as the risk of losses in on and off balance sheet positions arising from movements in market prices. Now, this definition, according to me, it is better transformed in a more operative definition, that is, the risk of losses in our portfolio because of changes in the value of the underlying market variables. Because prices can be a little bit misleading. Obviously, in Basel and at the Basel Committee on Banking Supervision, when they say prices, they mean the value of the market variables. But if we say explicitly the value of the market variables, then we have the price of the assets, we have, for example, the level on the interest rates, the level on the exchange rate, we have, for example, the volatility, and all the other things that we shall see actually have an impact on market risk, because we will see that the value of our portfolio can be affected by different quantities. We know that volatility has an impact, we know that trivially the price of an asset has an impact, but we can assume also from financial mathematics that interest rates have an impact, the exchange rate have an impact, and so on. So we will consider that. In the Basel framework, market risk belongs to the so-called first pillar, because it represents one of the most important types of risk that a bank may face. Together with market risk in the first pillar, we find credit risk, operational risk, and more recently, after the crisis of 2007-2008 and the arrival of Basel III, also liquidity risk. Now, the first pillar of Basel is one of the three pillars of the so-called Basel construction. It's the pillar devoted to the minimum capital requirements. That is to say, is the pillar in which we find all the rules, all the regulations, all the details about the way in which a bank needs to approach the most important types of risks: market, credit, operational, liquidity. The other two pillars are the supervisory review and the market discipline pillar. There we find a lot of extra rules, a lot of wishful thinking, especially in the market discipline pillar is really a lot of wishful thinking. It's a continuous amount of rules that are generated over time, but we will be back on that and at least on what I personally think about the Basel framework. But in this video lesson, we will not enter too much into the background of the Basel construction. For what concerns the Basel framework, I refer you to the readings that you find on Brightspace. Okay, so they are very important because they allow you to understand the big picture, but for us, it is more important to focus on the different type of risks and on the different methodologies that we can use to approach them, to identify them, to assess them, to prioritize them, which is actually, as we said in our first lesson, the job of risk management. The most important tools that we can use to assess and hedge market risk are the value risk, the expected shortfall, and the Greeks. In reality, for what concerns the value risk, we will see that there is also a second version of value risk, which is called the stressed value risk, the stressed VaR, which is nothing more than a value risk computed on the losses that belong to the worst scenarios for our portfolio. But we will be back on that in our practical lesson with R. For what concerns the Greeks, we will see together that the Greeks are a set of tools that from a mathematical point of view are nothing more than derivatives that we can use to study the sensitivity of our portfolio to different important market variables like the price, like volatility, like time, like interest rates, and so on. The use of the Greeks is more important in the other approach that we will see in lesson 10, that is the model building approach, and less relevant for the approach that we consider today, that is to say the historical simulation. So for what concerns the Greeks, we will be back in the next lesson. In the Basel framework, value risk and expected shortfall represent the inputs of a series of formulas that the Basel Committee prescribes to banks in order to assess and hedge market risk. In particular, those formulas are meant to compute the so-called minimum capital requirements. So on a daily basis, because we will see that for market risk, the common time horizon is 1 day. For credit risk and operational risk, it would be different. It would be, for example, 1 year. But for what concerns market risk, a common time horizon is 1 day. On a daily basis, banks are supposed to compute the minimum amount of capital that they have to keep as a reserve in their balance sheet in order to hedge the possible losses coming from market risk. And all these formulas are dependent on value risk and expected shortfall. An example of these formulas is what you see now on your screen. We will not enter too much into these formulas. They are not particularly interesting. You can see from the formula itself that it's just a matter of plugging in the values and you get your number. Okay? In the readings you can find a little bit more details. For us, it is more important to understand how to compute actually the value risk and expected shortfall using the different approaches to market risk. At the end of the day, once we have our values for the VaR and expected shortfall, we input these values in formulas like that you see on your screen, in which you also see the so-called stressed VaR that, I repeat, will be treated in our practical lesson with R. In the example of formula that we have just considered, the value risk was the only type of input, the average of the last 60 days, the stressed VaR, but yet it's just value risk in different declinations, in different flavors. What about the expected shortfall? Actually, in Basel 1 and Basel 2, so more Basel 2 than Basel 1 was just a very basic setting. So in the very long and verbose Basel 2 setting, the queen measure to assess risk for market, credit, operational, for everything, also for making coffee, was the value risk. Now, we know that the value risk has a lot of problems, so it's not always coherent. It has been criticized. We will see that a problem that is inherent in the value risk, especially when embedded in the Basel construction, is the so-called procyclicality of VaR. And so the value risk has been criticized a lot. Okay, it has been considered one of the responsible guys of the financial crisis of 2007-2008. As I told you, at least according to me, it is never the fault of a given measure. It is always the fault of those using a given measure without knowing what they are doing. So, because of that, that risk has been somehow considered more and more risky as a measure to rely upon, as the only measure to rely upon. That's why expected shortfall has started gain importance. And now we are actually in a transition period. According to the fundamental review of the trading book, we will see that starting from 2022, the expected shortfall will become a leading measure for the assessment of market, credit, and all the other type of risks. So there will be new formulas that will substitute those that we have been using until now, in which the valid risk was the most important input. And in the new formulas, actually the expected shortfall is becoming the most important input. Is this an improvement? Okay, the expected shortfall is a little bit more reliable with respect to valid risk. Yet, we are making the same error. So we are just substituting one measure with another. It is another measure which is a little bit better, it is coherent and blah, blah, blah. Yet, just relying on one measure is never, never, never a clever idea. It is always better to use different sources of information, and in particular when you play with objects that can generate, as we know and as we will see in applications, fat tails, it is always better to consider the full distributional properties of the objects we are playing with instead of just a couple of summary measures, okay? Especially when these measures are the valid risk and the expected shortfall. As I already told you, in the Basel framework, when speaking about market risk, we have two main approaches, the historical simulation and the model building. We start with the historical simulation. These two approaches are different for several reasons that we will investigate, but at the end of the day, both approaches have one common goal, that is to say, to generate a loss distribution. And from this loss distribution, we will compute the valid risk and the expected shortfall that will represent the inputs of our formulas according to the minimum capital requirements of Pillar 1. The historical simulation approach is an approach that relies on past data in order to make predictions about the future. In this sentence, you should already see what are the problems of the historical simulation approach. That is to say, an over-reliance on the past, which is bound to generate historical bias in order to predict the future, and that connects to the forecasting paradox. But we will be back in a minute on these topics. Nevertheless, the historical simulation approach, and this can be more or less as scary, is probably the most used approach for market risk by all banks, and in particular the very large ones that invest a lot of money in their historical simulations for market risk. Following the Basel regulations, assume that we want to compute the one-day 99% valid risk for our market portfolio. In the historical simulation approach, we need at least 501 days of data, and in particular the last 501 days. So if you want, is a moving window that follows us with time. So today we look at the last 501 days in which we have monitored our portfolio, looking at the variations of the different components that constitute our portfolio, the different assets, the different options, and so on. Okay, so and we have collected the values of these different components over time. Why 501 days? Because we want to generate 500 scenarios, and these scenarios are generated on the basis of daily variations. So looking at the daily variation, we lose one of the elements in order to generate the 500 scenarios. Other common quantities are 600 scenarios, so we use 601 days, or 1000 scenarios, and we use 1001 days. But at least we need to use 500 scenarios. So the first thing that we have to do in the historical simulation is to identify what are the market variables that affect our portfolio. Now, it is not difficult to see using intuition, but also, as we shall see when we introduce the Greeks in lesson 10, that these quantities are usually the price, the interest rate, time, because obviously of the time duration of the horizon that we are considering for our investment, exchange rates, volatility, and so on. Now, once we have identified the different market variables that affect our market portfolio, what we do, we monitor the value of these variables over time, and we use the data in order to generate possible scenarios of variation of these variables, looking at what happened in the past. So let's consider our 501 days of observations for the different market variables that affect our portfolio. We call day 0 the first observation, that is to say 501 days ago. Day 1 will be the next day, then day 2, day 3, day 4, until today, that we call day n. Now, the first scenario is nothing more than the scenario that takes into consideration the daily variations we observed between day 0 and day 1. The second scenario is the scenario that takes into consideration the daily variations we observed between day 1 and day 2, and so on. Okay, so since we have 501 days, the last scenario, scenario 500, is the scenario that takes into consideration the daily variation we observed between yesterday and today. Okay, so these 500 scenarios are what we use to generate the possible new loss distribution. As said, take today to be day n, and let Vi be the value of market variable V in day I. According to the ith scenario, the value of my market variable tomorrow is Vn plus 1 equal to Vn, the value today, multiplied by the daily variation that we observed between I minus 1 and I. So by multiplying Vn for the ratio Vi over Vi minus 1. So the fact that we need at least 500 scenarios is clearly stated in the regulations. So the question is, what happens if we do not have enough observations in order to generate 500 scenarios? Now, if the number of missing observations is limited, we can try to increase the sample size by using techniques like bootstrap or jackknife. But if this is not possible because we, for example, need a substantial number of observations and bootstrapping would generate a sample that is not reliable, then we have to switch to the other approach that we will consider together, that is the model building approach. Once we have generated the different values for our market variables, it is easy to compute the loss distribution, as we shall see in our R example in the next lesson. And once we have the loss distribution, we can compute quantiles, so the valid risk, we can compute means over quantiles, so the expected shortfall, and we can compute all the other quantities we might be interested in. Actually, I always suggest to do more than what the regulator suggests and imposes to you. Now, but what's the problem of historical simulation? As we already observed, historical simulation is bound to be subject to historical bias, that is to say, to over-rely on the past in order to make predictions about the future. You consider the past an optimal predictor of the future. But you can understand that looking at what happened in the last 501 days or more tells you only a little part of the story of what can actually happen tomorrow. Okay, it's not that if something has not happened in the last 501 days, it will not happen necessarily tomorrow. That will be the error of the turkey's fallacy, if you remember that. So the fact that the turkey was assuming that the world was wonderful until Thanksgiving. And if in your last 2 years or so of data you don't have the default of Lehman Brothers, then you assume that Lehman Brothers cannot default, which you see is not a very clever thing to assume. So what's the point with historical simulation? Historical simulation tends to give too much weight to the past and to ignore other things that are not immediately observed in the data. A possible solution can be, for example, to complement what we observe in the data with extreme value theory, because then by putting our parametric behavior or semi-parametric behavior of the tail, we can try to extrapolate a little bit more information than what is immediately observable in the data. Because the point of historical bias is fundamental. We cannot risk looking at the future in a telescope that looks back. Okay, because it is like driving just looking at the mirror without looking in front of you, which is quite a problem, can be very, very dangerous. I do not recommend driving in that way. So please remember, when you use historical simulation, that you have to be careful about the fact that you might be inclined to underestimate risk. Imagine that the last 2 years of observations come from a good period, and then you enter in a period of crisis. What happens is that you are essentially trying to model a period of crisis using observations from a good economic period. So you see that there are many problems coming out. So always be very careful when using this type of approaches. After the discovery of this mythological animal that we call historical bias, thanks to the crisis of 2007-2008, regulators started thinking about possible solutions for historical bias. And in moving away from Basel II, by introducing Basel 2.5 and Basel III, they propose things like the stressed VaR, which is nothing more than a VaR risk computed on the most stressful scenarios that we have observed in the past. Yet also the stressed VaR you can easily understand, and you will easily understand when we consider the practical application, is subject to historical bias. So essentially we are not really solving the problem of historical bias. We are just hiding the dust under the carpet. So we are just trying to make up a little bit things, but we are not substantially treating the problem of historical bias. What can we do in order to solve historical bias is to try to actually, at least my view, is to combine the historical simulation with some real modeling, not just get this simulated loss distribution and compute the valid risk and the expected shortfall. So it is okay, we have to start from data, so I'm not saying that data are not important, they are fundamental, but then we don't need to stop there, we don't have to stop there, we don't have to be fooled by the data. So we have to use the data to do something meaningful, okay? I will try to elaborate more on this later, after introducing the model building approach, and also when we wrap up the course at the end and we deal with model risk. In the basic historical simulation approach we have considered so far, we were implicitly giving the same weight to all the observations. So there was no difference among the different observations. Day 0, day 3, day 200, all had the same weight for us in the computation and in the generation of the possible scenarios. Now, it may be the case that we believe that, for example, observations that are closer to us in terms of time have a higher impact on the possible scenarios, on the possible behavior of our portfolio tomorrow. Okay, in a sense, we are even increasing historical bias even more. But if we ignore that, a possible way of generalizing the historical simulation approach is to introduce weights. Okay, there are different ways in which we can do that. A very simple way of introducing weights is the following, in which, thanks to a parameter lambda of our choice, we can decide to penalize some of the scenarios, typically the oldest ones, but if you want, also the most recent ones. It all depends on the value of lambda that you choose, okay? And thanks to these weights that you see on your screen, we are given weights that sum to 1 and that have different properties, again, depending on the value of lambda. In this way, we are saying that, for example, we trust what happened in the last days more than what happened, say, 1 year ago, or vice versa. Again, I stress, the more you increase the weights and the more you restrict, in a sense, your attention to a smaller subset of data, because if you increase the weight of a given portion of the data, then essentially you are increasing the relevance of that portion, then the more historical bias you are introducing in your model. Another possible way of weighting the observations is to use volatility as suggested by Hull and White. According to Hull and White, the idea is that we give more relevance to those observations for which the market variables experienced in that particular time period the higher volatility. Why? Because we believe that volatility obviously is an important factor for us and we want to keep that information in our scenario generating mechanism. Okay, the model of Hull-White is what you see on your screen, and again, it's another very simple formula. We could discuss if it makes sense or not to use volatility in this way, but it's one of the possible options that we can use. At least, according to me, once again, it is better to use other approaches like combining extreme value theory with historical simulation in order to try to have a better inference regarding the very upper tail, that is the tricky beast for us, which is the part that can generate the biggest losses that we want to be able to hedge. Okay, now what we have to do is to try to use historical simulation in practice, and this is the goal of our next video.